Hello everyone, and welcome back to A Stitch in Tax Saves Cash. I'm Olatunji Abdulrazak, your tax instructor and the founder and CEO of TaxMobile.online. Today, we're diving deep into one of the most game-changing provisions in the new Nigeria Tax Act, 2025. We're talking about Section 7, Nigerian dividends. Now, if you're a tax professional, an investor, a CFO, or a business owner, this episode is absolutely critical for your compliance and strategic planning for 2026 and beyond. This isn't just about numbers, it's about understanding the future of corporate taxation in Nigeria. Let's get right into it. So, what exactly does Section 7 cover? At its core, this section defines what a Nigerian dividend is for tax purposes. But it's not as simple as you might think. The law actually splits this into two major categories, and this is where the details really matter. First, we have the straightforward category, actual distributed dividends. These are the dividends that companies formally declare and pay out to their shareholders. It's the profit share you receive. But here's the crucial part, the tax law looks at the gross amount, not the net amount you receive after deductions. For instance, if a company declares a dividend of 100 million naira but deducts 10 million naira as withholding tax, or WHT, the taxable dividend amount is still the full 100 million naira. Why is this? The government's goal is to prevent the erosion of the tax base. Tax must be applied to the full distribution value, ensuring that the entire economic benefit is accounted for. This prevents companies from using deductions to artificially lower the taxable dividend amount. Now, let's move to the second category, which is where many businesses can get tripped up, deemed dividends. This is a concept where profits are taxed as dividends even when no cash has actually been paid out to shareholders. This is a powerful anti-avoidance measure. Section 7 extends the definition of dividends to include profits that aren't distributed but are treated as distributed under any Nigerian law. What does this mean in practice? It means that retained earnings, those profits a company keeps instead of paying out, can be taxed as dividends in certain situations. It also means that excess dividend rules might apply, and anti-deferral rules will kick in if companies are found to be accumulating profits indefinitely just to avoid paying shareholder-level tax. This provision effectively closes major loopholes and brings Nigeria's tax framework in line with global standards, particularly the Base Erosion and Profit Shifting, or BEPS, initiative. It's a clear message: hoarding profits to avoid tax is no longer a viable strategy. So, the next logical question is, when exactly does the dividend tax obligation arise? Section 7, subsection 2 provides a simple but incredibly powerful rule. Dividend income arises on the date the dividend becomes due and payable. It's not the date it was declared. It's not the date it was eventually paid. It is the due date. Let me give you a clear example to illustrate this. Let's say a company's board declares a dividend in June 2025, and they state that this dividend will be payable to shareholders in August 2025. Under the new law, the tax liability rises in August 2025. This principle is fundamental because it aligns the tax system with the accrual basis of taxation. The moment the company legally owes the dividend to its shareholders, it becomes a taxable event. The money doesn't have to have changed hands yet. This provides certainty and eliminates ambiguity. What does this mean for companies on a practical level? Businesses must now adjust their internal processes. First, you must recognize dividend liabilities for tax purposes at the moment they become due. Second, you need to understand that delaying the actual payment of the dividend does not delay the tax obligation. The tax is due when the dividend is due. Third, this requires a tight alignment between your accounting department, your corporate governance team, and your tax compliance processes. The due dates declared in your board resolutions now have direct and immediate tax consequences. This new clarity is designed to remove ambiguity and prevent long, drawn-out disputes during tax audits. And what about the shareholders? This new rule has significant implications for you as well. For shareholders, whether you are an individual, a holding company, or a large institutional investor, the withholding tax, or WHT, applies as soon as that dividend becomes due. Even if the cash hasn't hit your bank account, that income is now considered taxable for that period. This is incredibly important for personal income tax filings and corporate tax returns. You must include the dividend income in the correct assessment year, which is the year it became due, not the year you received it. This requires careful tracking of dividend announcements and their corresponding due dates. So, what does Section 7 ultimately achieve for the tax authorities? It's all about strengthening the system. First, it brings certainty. Having a clear timing rule the due date makes the entire process predictable. Second, it creates administrative ease. It is much easier for tax authorities to determine the correct assessment periods when the timing is tied to a legally defined date. And third, and perhaps most importantly, it has a significant anti-avoidance impact. Companies can no longer hide behind strategies of declaring dividends but delaying payments, or simply retaining profits indefinitely to shield shareholders from tax. Nigeria is actively working to increase its tax-to-GDP ratio, and making the dividend tax rules cleaner, stronger, and more enforceable is a major step in that direction. Now, let's look at this from a legal perspective. This isn't happening in a vacuum. Nigerian courts have consistently upheld a strict interpretation of tax charging provisions. A landmark case that comes to mind is FBR versus Halliburton back in 2016. In that case, the Supreme Court ruled that tax liability rises exactly when the law says it does, leaving no room for subjective interpretation. Section 7 of the new Act builds on this legal precedent. By explicitly tying the dividend tax event to the due date, the law provides the kind of clarity that courts have always favored. This isn't just a local trend either. Globally, countries like the UK and India have implemented similar rules on the timing of dividend taxation precisely to prevent the manipulation of tax liability through timing games. Nigeria is aligning itself with international best practices, so let's bring it all together. What are the final thoughts on Section 7? This provision fundamentally strengthens dividend taxation in Nigeria in several key ways. First, it provides a comprehensive definition of Nigerian dividends, covering both actual and deemed distributions. Second, it offers absolute certainty on the timing of taxation, linking it directly to the due date. And third, it supports Nigeria's broader fiscal goals of boosting revenue and clamping down on tax avoidance. So what's the call to action? For companies, it's time to review your dividend policies and your internal reporting calendars. For shareholders, you need to be diligent in tracking dividend due dates to ensure accurate tax reporting. And for tax professionals, it's essential to update your advisory frameworks to reflect this new reality. The landscape has shifted, and we all need to adapt. If you found this breakdown helpful and you want to stay ahead of the curve on Nigerian tax matters, please like this video, share it with your network, and subscribe to A Stitch in Tax Saves Cash. Let's build Nigeria's tax knowledge base together. I'm Olatunji Abdulrazak, and I'll see you in the next session.